Hi, everyone. Welcome back to another episode of Trade with Conviction. Today is a special episode. We have for the first time our new colleague, Abhishek. Abhishek, hi, how are you?
Hi, Felipe. I'm good. Thank you. How are you?
Good, good, good. And obviously, we have the star of the show, June. Hi, June, how are you?
Hi, everyone. Doing very well, thank you.
Good to have you on the show, guys. Quite a special show today. A lot of things to discuss. We obviously tackle Trump, EIA stock draws, Russia, and so many more things on top of our classic crude, fuel oil, gasoline, and diesel kind of market coverage. But today we're going to be focusing particularly around India. There's a lot of things happening over there. And also Asia. So let's start with a round of what's happening in the market. June, maybe you can shed some light into the recent events.
All right. Well, we start with Trump, right? So on Monday, Trump called off a strike on Iran that was planned for Tuesday after the leaders of Saudi Arabia, Qatar, and UAE purportedly asked him to, as serious negotiations are now taking place. ICE Brent actually fell below $110 per barrel on that news. Status on Strait of Hormuz is still shut, but the market is celebrating small wins of more vessels exiting. On Tuesday, two VLCCs carrying Iraqi and Qatari crude is headed to China. On Wednesday, a VLCC carrying Kuwaiti crude is heading to Korea. The interesting part is, of course, to see vessels going back into the Straits. And I think we've heard now that the state-owned Shipping Corporation of India is rumored to have made plans to start going in once it has the approval from the Indian Navy and business from oil refiners. The IRGC also has set up the Persian Gulf Strait Authority, PGSA, claiming a wider area where transit requires coordination with and authorization from the PGSA. This area includes Fujairah, which actually sits outside the Strait of Hormuz. Of course, this has not been ratified by the UAE. Okay, and then on US EIA data, the SPR stock draw is like close to 10 million barrels and heading to multi-decades low. Commercial crude draws is now at 7.9 million barrels, Cushing at 1.6 million barrels. So total crude stocks draw was a massive 17.8 million barrels. The product side, gasoline drew 1.5 million barrels, residue drew a little bit, but diesel and jet fuel edged slightly higher, giving us total product stocks draw of 1.7 million barrels. The diesel story is a bit more interesting. We see PET 3 building 2.5 million barrels, so the implied demand in the US has really fallen heavily. PET 1 stocks dropped 1.8 million barrels, which drives HOGO spreads more. In total, we have 19.5 million total crude and product stocks draw, which is the largest stock draw in history, including SPR. And yet, the oil markets barely reacted to this. Flat price actually fell to $105 per barrel when Trump proclaimed that we are in the final stages of the war, and market is still choosing to latch onto hopes rather than the physical reality of multi-year low inventories.
Yeah, the diesel story is quite interesting because, correct me if I'm wrong, Abhishek, Gulf Coast exports by foot force for diesel. So you would expect that to be drawing. What are your sentiment here? I'm sort of putting you on the spot, but
Yeah, you're right in saying so, Felipe. But a couple of things which has happened. Earlier, we had seen clear sign of arbitrage open from USDC to Rotterdam, which is now still open but slightly patchy. It is open for few window, but again closed. So there could be a possibility where we'll see slightly reduction in export. A couple of things comes to my mind looking at the latest EIA data. What we have seen is yes, this diesel stock especially and overall US is still low, but it is picking up, and the major factor over there picking is the demand. We have seen a steep drop in diesel demand in USA. We were expecting, because the stocks are low seasonally, it builds around this time,
yeah.
but still lower than historical 5-year average, and we were expecting what will reduce or help in building that stock, and we were thinking that either the export will reduce or there will be higher runs. But in fact, with the latest numbers, we have seen a demand going down in USA, which is kind of again helping in building that stocks.
Interesting. We'll talk more about that. I have some thoughts that I'd like to share, but in general, about this whole phenomenon between we're running out of oil, which is a certainty, and we're seeing the stock drawing and all that, but the market, not necessarily flat price, but there is this uncertainty going on, where with, well, we actually have oil, right now, generally speaking, and we'll talk about that more. So it's interesting how to position yourself in that kind of environment. But before we talk about that, you mentioned Russia, and there was obviously the Xi Jinping meeting with Putin just after Trump. What did we learn about that?
Nothing really much came out of that. It's just for Xi Jinping reiterating calls for Iranian war ceasefire. Aside from that, no real energy deals that was concluded. But maybe the more interesting point is continued attacks of Ukrainian drones on Russian refining infrastructure. We have seen now about 1/4 of Russia's total refining capacity that has either been fully or partially halting operations because of these attacks. Kirishi is one of the largest refineries, about 20 million tons per year, has been fully shut down since the 5th of May, whilst the latest attack over the last few days was on the 17 million metric tons per year North Sea refinery. But of course, the bigger headlines is on the sanctions waivers changes for Russia. First one is OFAC. So the latest OFAC sanction waiver for Russian oil, which is the general license 134C, is applicable for crude and oil products loaded as of 17 April for sale until 17 of June 2026. However, if you look at the fine print, the previous sanction waiver on general license 134B was also applicable for cargoes loaded as of 17 April 2026, but for the sale till 17 May 2026. This means there's no actual incremental Russian barrels for this latest set of waiver. So therefore, we have this bullish view on FOB crude diffs unchanged as a result of this waiver. India will still need to find their barrels elsewhere if there is no further extension on the timeline of cargoes that are allowed for the sanctions. But bear in mind, we do have a bit of WAF crude overhang as well for India to pick on those cargoes.
So just to clarify, so it basically means that they've extended the sale period from the 17th of May to the 17th of June, but for the same amount of barrels. It's not that we've now extended the volume. Okay. So you just have more time to sell what you already have, but it doesn't really solve the supply problem. If
yes,
I understand
and I think the market missed this point because when even for myself, when I first heard this news, I said, oh, okay, yeah, there's another extra cargo for India to tap on. But when you look into the fine print, that's what it is.
Okay.
The second waiver, or more like a delayed ban, is from the UK, where they have given a general license allowing imports of diesel and jet fuel refined from Russian oil in third countries, benefiting mainly India and Turkey. And that takes into effect from the 20th of May with no time limit given. Of course, this has drawn a lot of criticism, and the UK government is trying to make this as temporary as possible. And a good reminder to everyone that the UK is the most exposed in Europe in terms of jet fuel import requirements. So probably this sounds like a desperate move.
I guess that, I don't know if you remember Groucho Marx, but he used to say, well, these are my values, but if you don't like them, I have other values. And I think that seems to be the new case in the UK right now. Other headlines from the Far East. I keep hearing that China is puzzling the market in Asia. And obviously, the products market is heavily dependent on Chinese exports. And we saw at the beginning of the war that they had an export ban. Then they released that. So I can assume that everyone is sort of very dependent on what China decides to do. What can you tell us about that?
We start from the crude story. The crude imports have been very low. The run rates for state-owned refineries in April was actually also trending lower. For this to happen, we saw China instructing the independent refineries to run harder. So overall net impact domestically, you still have enough oil. At the same time, there are reports that the crude inventories, the onshore crude inventories in China was essentially flat, even though the crude oil imports were lower. And in terms of Saudi allocations, which is a more transparent figure in the market, the June loaders number is only about 12 to 14 million barrels compared to the 2025 average of 45 million barrels. So when people look at the crude deltas, I just want to point out that don't forget last year, China was doing a lot of stock building. So the crude that you see is not exactly just a refining demand figure. Maybe you should discount about 1 million barrels per day or so. And now on top of that, we have a US pressuring Iran more with sanctions on China's independent refineries, notably Hengli, which is a 400 KBD integrated petchem refinery, and the teapots running at negative margins. This is likely that more likely that the teapots will need to reduce run rates in the coming months whilst the state-owned refineries intakes to increase. So it's a bit of a puzzle because you have the jigsaw puzzle doesn't quite match right here. Yeah.
Doesn't give any kind of certainty right now.
Yeah. For the rest of the Far East market, we see a bit of a group buying trend. Japan and South Korea announced that they are going to set up a framework for crude oil procurement, a cooperation, including joint reserves. Both countries will seek financial and technical support to build an oil reserve storage system. And earlier this month, ASEAN, Southeast Asian countries, plans for a fuel sharing pact and started talking about a regional energy stockpile. Australia is seeking budget approval to increase stockpiles to 50 days, and New Zealand is seeking fuel storage options potentially in Singapore and Malaysia. So it all fits into our reinventorizing theme in Asia ahead of the Atlantic Basin, which is currently in the destocking mode.
It's interesting because, if you think about the doomsday scenario where we're really running out of oil, the assumption is that we go back to the law of the jungle, where everyone is sort of fighting for their own barrels. And this could even apply, it's not just Japan versus Korea, but also within Europe, you're going to have Spain versus France fighting for those cargoes. Imagine that you're in a scenario where there's just one jet cargo left and Spain is going to try to buy it, France is going to try to buy it, etc. No, it's no longer companies, it's now countries and things like that. But what you're saying here is, in a certain ways, they're already in the mindset of what happens next. It's like, this is going to be resolved, but it might happen again. Let's organize ourselves so that we have that security of supply. We don't get caught in this scenario again. But you see, and it's interesting because to a certain extent, by thinking about the future and what will happen next, you're already discounting that this will be resolved, you see?
Indeed. But I think it's in the front of all Asian countries' mind because we are, by design, heavily reliant on the Middle Eastern crude, and the risk will now be amplified.
Yeah. No, I get it. Yeah. So India. We said we're going to do a special on India. Modi has been on the headlines quite a lot recently. And I'm particularly curious, we talked about demand destruction coming mostly, it's going to be a situation who pays up more for this oil. No? In the event that there's less oil, we run out of all these stocks, all of these measures that we implemented, and the market, to be honest, as I said last time, did a phenomenal job in making sure that the oil was in the right place at the right time. And we avoided major crises and shutdowns, running out of stock. But the question is, okay, so how are countries like India managing this internally? No, I'm very curious. What can you tell us about what's going on in India?
Yeah, Felipe, you're right in saying so that there have been quite few updates on India. As you know, country is heavily dependent on crude imports. So sustained high prices directly affect economy. And this is why we have seen PM Modi appeal to citizens to reduce fuel consumption wherever possible. So far, government has absorbed much of the shock through tax cuts, excise adjustment, and support to OMCs. But the recent petrol and diesel pump price hike after almost 4 years shows that this cushion also has its own limits. And that's the reason crude from Russia becomes even more important, especially around the time when EG supplies are strained. Around the time when a previous waiver expired from US, official statement was that India will continue purchasing Russian crude regardless of whether the United States extends the sanction waivers or not. But recent extension by US on waiver, in my opinion, removed that unnecessary friction between the countries. Though fine detail mentioned cargoes loaded before 17th of April, but in context to India, there is small things to note and highlight. Similar, like with Naira coming back from maintenance, Russian crude purchases should pick up again, regardless of those earlier loading date restriction, because Russian barrel and Naira are both on the same boat of sanction. At the same time, reports suggest that India is preparing to send vessel through the Strait of Hormuz once government approval is finalized, as June highlighted. It shows that the country is trying to keep both Russian and Middle Eastern supply channel open as much as possible.
Interesting. And what is the I heard about LPG, obviously high dependence on LPG. Have we seen that demand destruction simply because of lack of supply? And my follow-up question to that would be, what's the sort of social situation there? Are people angry? Do we see any kind of signs of unrest or anything like that? And I'm using India as a proxy of countries that have been heavily affected.
So yes, in terms of LPG, we have seen demand destruction, but more from the availability perspective. But as far as oil product is concerned, in fact, we have seen year-on-year growth in April. There is a nuance to it because there were few state election going on, and government maybe because of that decided not to increase the prices during that period. So even when the fuel prices across the globe kind of almost doubled, the pump prices in India remained the same as it was before the war. However, and those pressure were taken care by the government, but recently government has increased the fuel prices, but those prices are not very significant. Those prices are hardly 2 to 3 rupees per liter, which is 2 to 3% or even 4% max based on the previous number. People in India are looking at it. They understand the geopolitics that across the globe prices have increased, and because it is just on the back door, that Strait of Hormuz situation, and the prices have not increased significantly. Yes, there are fears that if this continue, those pump prices will jump or even go higher. But at the moment, those prices or price hike are not significant, and yeah, it's in wait and watch mode. But as of now, there is not a lot of a major concern from a consumer perspective, as long as those spikes are or price hikes are not significant in percentage terms.
Yeah, the government is absorbing all of this. Yeah.
I think the unrest that we are seeing is in Africa. There are reports that I think in Kenya there were protests over the high diesel prices. So we are seeing that pockets of social injustice, if you like, in some of these other countries.
Yeah, and June, you were asking me earlier about that Reliance is going into maintenance, and then how will it impact on the Russian crude purchase? So, Russian import will increase, in my opinion. Why? Because the Reliance DTA refinery is going into maintenance, and Reliance DTA or Reliance had other option to source cargo from. However, the Nara, which is 400 kbd, is heavily reliant on a Russian barrel, and they are not limited to these restriction of 17th of April, and they're not competing with the same barrel which Reliance or other companies or country are chasing for. So from that perspective, yes, there will be marginal impact because of Russian DTA refineries going into maintenance, but because Nara will take the non-date restricted cargoes, so it's chasing or competing for a very separate barrels, and because of that, I see increased Russian imports into India. And even though that DTA refinery is going into maintenance, that is only for a couple of weeks. So it might happen that purchase will happen and delivery will be slightly later. So yeah, in terms of that, I still see a Russian import increasing month on month because of this. So this was all on the product, on the crude side. On the product side, we have seen UK waiver on import diesel and jet fuel produced from Russian crude could allow more Indian and Turkish barrel to flow into the UK. However, current economics suggests that arbitrage is not open from this origin to UK. Apart from price, it surely provides an additional supply source in case of dire need. But it also opens up a thought, like if there is a situation where the supply is crunches, so other country can open up the waiver as well. What we have seen in case of UK. So this is all what has happened in short term related to India, but because the impact was so huge, government needed to think something on the long term as well. So on the long term, India is also trying to expand its SPR buffer. Current SPR nameplate capacity provides only around 10 days of cover, excluding commercial stocks, while the recent agreement in UAE, ADNOC, aims to add another 25 million barrel of SPR storage. Additionally, India will also explore the potential to store crude in Fujairah. Though these things will not impact prices in near term, but it definitely acts as an insurance in long term. So in case similar situation or supply disruption happen in future, government has something to fall back upon.
Yeah, we go back to the narrative of preparing for the future strike. Anyway, so let's go back to our usual segments around what we see in the markets. Maybe start with crude. June, what's the physical story telling us? What are the main drivers of the crude market right now?
The key overarching view for Asia is that we are quite well supplied for August deliveries. I think it's a case of overbuying at the onset of the crisis. No one currently wants to be caught buying expensive replenishment cargoes now, especially we are hearing more cargoes exiting the Strait of Hormuz. These cargoes coming out, they will take about 14 to 21 days to arrive in Asia, and they are kind of extra barrels that will be part of June processing, but in physical cargoes, we are trading August arrival barrels. So therefore, there's a prompt overhang of cargoes, and backwardation is now, we're looking at the June-July Brent swap spread is about $4.50 per barrel. So nobody wants to be caught holding unsold cargoes at this high backwardation cost. On the product tanks, particularly diesel, it is held to be quite high in China and in Thailand, where export bans were initially enacted to the point of limiting the current crude runs. So we need to see exports allowed again, product exports allowed again from Thailand, particularly in Thailand, so that the crude intake can increase higher to capture the current prompt strong margins. Just to give an idea of where the margins are, we are seeing Melbourne medium cracking margins in the Far East at about $7 per barrel positive in August. On the US imports, WTI into Asia is still very strong. Japan has purchased 15 to 16 million barrels of US crude for July arrivals and up to 30 million barrels for August arrival. Japan also has diversified crude sources from Mexico, Ecuador, Venezuela, Alaska, and even Russia, Sakhalin too, and are not expecting procurement problems during the peak summer demand. Going into North Sea, the physical side is quite strong. We are now seeing a situation where more Atlantic Basin barrels are heading east, and therefore the physical market in Europe is a bit tighter. Our trade call on higher crude FOB diffs are coming out quite well. We entered the trade at 40s FOB dated plus 93 cents per barrel. Currently is at 284 cents per barrel. So that strength, I think, should start to also filter through to the WAF grades, currently sitting very undervalued at the back of China shunning the crude buying, but looking at fairly good margins for the Northwest Europe refiners.
Yeah, no, it's interesting. This, I have a lot of friends that are telling me, but you're saying, oh, there's an overhang, there's too much product, but at the same time, we're drawing stocks at crazy rates, and we're running out of oil. What's the story? And it's all a question of there's relative to spreads at the end of the day, because if you have, whether it's diesel, gasoline, crude, etc., time spreads that are at extremely record backwardation levels, any kind of additional oil cargo that arrives that puts a lot of pressure. So it's a question of, it's that time horizon of, yes, we're running out of product, that is obvious, and crude, but when is that moment where you hit? And we saw that with diesel, and we're going to talk about diesel, but we saw that with the expiry of diesel last month, where it dramatically fell. Now, obviously, it's bounced back in Europe. We're now at 23, I believe it is, on a time spread. At the end of the day, the market, everyone is long. Every single person in this market is long right now. Why? Because that's what that's the evidence is showing you. But when you are at $30, $40, $50 backwardation in tons basis, you're already doing the job. You're already telling everyone, empty your tanks. So then it's that really nitty-gritty detail of, okay, do we actually have the product right now to supply? Because if you do, then you're just going to be dumping it. And that 30 can be easily become a 10, because you're doing even at 10, you're doing the job. You're getting rid of the oil. So you're in this sort of territory where the market has already reacted. But anything between, let's say, $15 a ton backwardation and 50, it's the same result at the end of the day. And how do you trade that? I don't know. Anyway, so Abhishek, what can you tell us about distillates?
Yes, on diesel, we have been talking about East-West recently. I have a slightly different view than the desk. We have seen East-West has bounced sharply, with June recovering from around minus $5.75 per barrel to near 2.5. What we are observing is that buyers are waiting until the last moment to secure the cargoes in hope that situation and price eases, as many were caught earlier when they rushed to buy during the escalation, only to see prices correct sharply after. This delayed covering behavior can create short-term squeeze risk and may partly explain the recent uptick. And there is no denial that this risk remains. However, my opinion, Asian strength should be capped by supply. China export relief has not arrived in size, but Korean exports have been steady. And even West Coast India's Sikka economics, though negative, but still points barrel towards east in Singapore and Australia rather than west to Rotterdam. On the other hand, Europe still needs barrel. The UK waiver on Russia crude derived diesel and jet suggests supply is not that comfortable, while the USGC to Rotterdam arb remains patchy rather than the clean one. As a result, July arrival could be lower than the recent level, what I see from the pricing and flows, my understanding on the market. We have seen these arbs were cleanly open earlier from US, and as a result, high level of diesel imports into Europe coincided with a fall in ice gas oil spread, which you were mentioning earlier. but low US distillate stocks, especially in Part 1, along with that not so clear ARB economics from USGC, should keep ICE gas oil cracks supported, in my opinion. And therefore, I prefer expressing this situation in Europe through constructive July ICE gas oil cracks, but I would stay more conservative on July East West because of Asian supply relief, which can cap the rally. And as June was mentioning earlier, there have been few flows of crude cargoes heading to east. That will also provide some relief from the feedstock side.
And on jet?
Yes, again, to the normal view that we are going into peak summer demand and there should be jet demands as well. But as we were discussing earlier, market has been pretty efficient and somehow found a ways to manage supply. And in my view, jet is bearish, especially in Northwest Europe, SIF jet differential, because the market has multiple supply buffers rather than a clear shortage signal. In the US, jet yield is around 2 percentage point above the previous 5-year average, while the jet fuel stock and exports remain elevated. That means the US can continue acting as a relief valve for Europe. And recent data suggests that yield has come off a bit, but it's still very much elevated. On the other side, European refiners have also been maximizing jet production to offset the loss of Arabian Gulf supply. On top of that, we have seen policy change to use jet also as an option to use Jet A with Jet A1, along with imports from US and even Dangote, has reduced that risk of hard supply squeeze. In fact, UK, which is the most vulnerable part of European system, because it imports roughly half of its jet fuel from Arabian Gulf, especially after two major refineries closure last year, remain resilient, and reports suggest the country should manage through the summer. Even few European airlines have said so, that they do not expect fuel shortages in the prompt. UK waiver, what we have seen recently on jet fuel produced from Russian crude in third country, could also add another supply buffer. We can debate whether those barrels come cheaply or not, but the key point is that additional supply is available if the market need is, and there are ways to do it. So that's how I see the jet market in west of Suez. In east, while in principle I'm not constructive on jet fuel in east either. In fact, my previous analyst brief for jet, I had given short regrade call, which indeed performed. But because China is a wild card and can increase and decrease the exports, create that sort of uncertainty in the market. And that's why, given the current dynamics, Northwest Europe SIF jet differential, especially July, would be my preferred trade on the jet side.
Very interesting. And it goes to show again how efficient the market has been, and perhaps in this case, over efficient when it comes to jet, as everyone was crying, not crying wolf, but was alerting the situation around jet fuel shortages and jet being the most impacted. And the market did the job. Again, we can remonitor in 3 weeks' time and be bullish again because things have readjusted, and that's the efficiency of the market. But it's quite impressive. Now we're running out of it, and then now we're balanced, at least for the time being. Let's see. On fuel oil, what did you hear from Hua in terms of the 0.5 market and the very hot VGO premiums?
All right. So Hua is our fuel expert. This is all his market calls. The same 0.5 June crack hit our target of $19 per barrel before retreating to the mid $16 per barrel range, while the physical diff continues to be firm around $45 per metric ton. With firmer zinc premiums and a softer freight, the Rotterdam zinc 0.5 ARB now looks close to being open for a June second decade Suez Max loader and potentially already open for an earlier loader. If this continues, we expect incremental up volume from the west, which should hit the east from about the second half of July onwards. Our usual 0.5 east-west versus physical freight and cost chart shows how the pendulum has swung the other way, with the June east-west some $25 per metric tons above our estimated physical freight and cost for the Rotterdam zinc routes. While the two don't necessarily have to match, the physical level has historically been the value that the east-west mean reverted to. At the same time, our estimated forward blend margin for 0.5 in Singapore have flipped back to very positive territory. Dangote LSSR, last done at plus 30s versus 0.5 barge, would still be very much in the money into Singapore blending at the current premiums. On the other hand, with the front high five around $100 per ton, Asian mid-sulfur barrels is now looking firmly better into the 0.5 blending again. Feedstocks continue to be firm with VGO delivered East Med at ICE plus $46 per barrel and the ICE plus mid-50s into US Gulf Coast. This is comparing against the mid-20s across the board just a short while ago. Secondary unit margins are doing the heavy lifting here. Meanwhile, Met LSSR streams hover around ICE plus $18 per barrel FOB. Receipt conversion incentive continues to look very strong in the West. In Asia, the receipt conversion premium relative to blending for heavy sweet crudes has also ticked up. So overall, our thesis for June Sing 0.5 has played out. While we are not bearish, and it's hard to be with the Strait of Hormuz still being closed, there is probably room for additional downside for 0.5 east-west from here.
Thank you, and thanks, Hua, for the update. Let's move on to light ends, starting with gasoline. June, what can you tell us about Singapore market or the Asian market with regards to gasoline?
Sing 92, June, July, neared the 5-year ceiling at about 6.80 2 days ago, but has since dropped to $6 per barrel as the AG gasoline stays physically stranded. Singapore is the cheapest into every traditional AG home market, Pakistan, Tanzania, Kenya, Saudi, Red Sea, and the tight MR availability in our markets here, only 8 versus the 23 average, is preventing the supply response that would normally cap this move.
Interesting. So you would expect then to have, and I can only assume that Europe and other areas of supply are way more expensive. So if you only have these 8 vessels versus 23, then there's definitely, the math basically tells us that there's going to be a shortage.
It sounds like it, but at the moment, I think we still see physical barrels are still plentiful. In Europe, it's getting less, but I think we are nowhere near a clear shortage situation. It's just a more expensive cost of supply.
In these destinations like Pakistan, Tanzania, Kenya, etc., if Singapore is the cheapest source of supply, but it cannot supply because the vessels are not there and all that, you might end up in a problem situation in these countries I'm talking, because the resupply is further away and is 10 times more expensive from Europe. So I just don't see that happening. Okay. Sorry, I interrupted your flow.
Okay, so that was Singapore side. And then on the TA, ARB is currently shut. EBOB is the binding constraint, not freight. The blender is at minus 3 cents per gallon. The refiner is at 0.5 cents per gallon, despite TC2 at 60-day lows. And the EBOB's Hormuz-driven rally has compressed the TA spread to minus 9 cents per gallon. ARA blend margins are open. The supply is beginning to accumulate, but West Africa and East Africa export pool keeps the EBOB elevated. The interesting point is the May 23 RVP waiver decision. That will be the catalyst that could reopen the ARB from the RBOB side. Component premiums are diverging from the cracks. Alkylate and MT premiums are weakening across all regions, even as gas snap hits 60-day highs.
Sorry, before we move on to naphtha, it's interesting because obviously the market was expecting the tightness to move into Europe or to move into the US. We started to see the spreads rallying across the Europe and US, particularly in the US. And then the ARB started opening and stock levels in the US started drawing to the point where everyone was expecting that, okay, summer season is here. We're going to go back to the old days where US was always buying cargoes from Europe in summer. And that started to happen. But now we're seeing that the ARBs has actually shut down. The ARBs to New York, So basically the market, US is saying, we're good. And we see this tendency a bit everywhere where, and we need to link this back to spreads of where they are, where people are just buying as little as possible to, you're basically moving from an environment where your base case is, 30 days of storage. And now your base case is 5 days of storage, but people just want to act on that very short-term window. So my interpretation of this is that you're going to have a very spiky kind of market where now it's closed, but then in 2 days' time, it can be reopened again because now we have no choice. We need to buy. And that's my interpretation of what we're seeing right now.
I think and you're right, the supply buffer that we used to have is now eroded. You start with a lower baseline. So spikes in fluctuations in pricing would be very extreme as a result of the loss of buffer.
Yeah, that's sort of my takeaway from what I'm seeing right now, because it does come as a surprise that the TAR suddenly shuts. But okay, we are at these kind of levels of flat price, of spreads. No one wants to own any barrel, at this level. But sorry, I interrupted you about naphtha. What's the story there with NAFTA?
Naphtha demand has been quite weak in Asia with the high petchem prices. Anecdotally, we heard construction companies delaying buying PVC piping by 6 to 12 months because they can't afford to buy at these levels. We also hear plastic pellets being exported out of Jeddah, which depresses the petchem Asian market a bit further. On top of that, we had Hengli's untimely sanctions, blowing another hole in the many players of the PX market here. So demand destruction is playing out pretty rapidly in the Asian chemical sector. June naphtha East-West currently has dived to about $40 per ton.
Yeah, after I think like even a month and a half ago, we talked about the demand destruction probably starting with products like naphtha that are where the demand elasticity is much more obvious than in other products like diesel or gasoline, which explains where we are with gas naphtha right now, despite sort of gasoline getting a sort of a ceiling in terms of spreads or demand, or we don't really see the cash dips neither picking up dramatically. So there isn't a pull on gasoline. It's just that we're stabilizing right now. Again, when I hear all of these things, and I speak to customers and all that, everyone is long. Everyone is long. There is not a single person out there that is short, and rightly so to a certain extent. But we are at elevated levels of spreads, particularly the ones that concern me is more than the cracks, is more the spreads, in the sense that you might be right in the direction, but you may be wrong in the timing. And maybe the spread is more the July, August rather than the June, July. And we saw that, as I said, on the diesel spread before expiry. And that's something that we need to keep an eye on. It's, it can be quite volatile. Anyway, those are my last thoughts. Thank you very much, guys. This has been a great show. Abhishek, welcome. Great to have you, and we'll hope to have you more often. And thanks, June, again for all of these insights.
Thank you, everyone.
Thank you, Felipe. Thank you, everyone.
Thank you.